Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, my name's Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We are speaking to a returning favourite here, James Abela. He's been on...
I think this is his sixth time I was having a look. Fifth or sixth time. Yeah.
There you go.
It's tough to come back multiple times.
Is it?
Yeah.
What, because we're such a tough interview?
We've got such a high standard.
So James is a portfolio manager at Fidelity. He runs the Fidelity Global Future Leaders Active ETF. The ticker for that one is FCAP.
Yep.
And he also runs Fidelity's Aussie Small Cap Fund. That one's not listed. He's run it for 11 years. He was Morningstar's Fund Manager of the Year 3 years in a row.
Yes.
He knows small caps.
He knows small caps.
And that's good because we want to dig into the small cap story in this episode.
Big time. I think it's a good time to be doing this because the year started strong with this is the year of small caps. We're about to see the small cap rotation. And I feel like over the last 3 months, a lot has changed in markets. Well, it has changed in markets. So we're going to speak to James about the rotation through the start of the year and whether or not it's actually playing out. Because we know a lot of you are sitting there and thinking about the opportunities in small cap. You want to be getting it as part of your portfolio. So, yeah, there's no better person to be chatting to at the moment.
Yeah. Now, to contextualize it, the Russell 2000, which is like the US small cap index, is down almost 10% in the first quarter of 2025. The S&P 500 is down just shy of 5%. And that is to be expected. Like when there's fear in the market and things are falling, you generally see small caps fall harder just because people sort of flee to larger, stabler, more defensive companies. And the first quarter of this year has certainly called for a defensive mindset. I think that's fair to say. But when we were chatting to James ahead of this episode, he said that especially in the global small cap land, which is a lot bigger and I guess has a lot more established companies than Aussie small cap land. He said there are still stable and predictable companies in global small and mids. Yeah. And we said, all right, well then bring a couple and we'll test you on them. So there's a couple of companies we're going to chat about today. An Italian company, Moncler, and a US company, Brown & Brown. Yeah. And we're going to chat about how there are, I guess, predictable and stable companies in an unpredictable and unstable environment.
Yeah, small cap doesn't necessarily always have to mean high volatility.
Yeah.
So we want to say a massive thank you to Fidelity for their ongoing support of Equity Mates and this episode. Without their support, we couldn't continue to make our content free and accessible for you guys. So a big thank you to Fidelity for their support. But Ren, without further ado, let's bring in James. Well, James, welcome back to Equity Mates.
Thank you.
I think this is the 5th time now.
Yes.
You're not sick of us yet?
No, it's good. It's good.
Now, we want to just start with a bit of an introduction to Global Future Leaders. For those listening today who haven't heard you on the podcast before, what is a future leader?
For those in Australia will know names like REA Group, JB Hi-Fi and Pro Medicus, and I've been in Fidelity for 20 years, and these are stocks that are up 50 to 100 times right over that 20-year period. And these are 50 to 100 baggers. It's really exciting, but how do they get there is the question, and how do you find them is the question. And all of them are what we call VSC, so high viability, high sustainability, high credibility, so high returns that are very high relative but high absolutes, but then also very sustainable and very high credibility in terms of accounts and management. And if you can hold that for 5 to 10 years, that's how you become a 5, 10, 20, 50, 100 bagger. And to see these things really lights my eyes up personally in finance and in markets because they are rare. They are rare to find these amazing, beautiful compounders, as you call them. And when you can find them and hold on to them, like that's how you make, substantial amounts of money and wealth. And that's how you look for them. So the future leaders really are those companies that are high return, high sustainable, high credibility management and accounts. And if you can find them, hold on to them, basically, is the message.
Future 100 baggers.
Yes, that's what they are. Yeah.
Nice.
You make it sound so easy, James.
It is. Well, it's not that easy. It's not that easy, but that's how you find them. The patience of actually holding them is actually the challenge.
Yeah.
Because you think, they're on 30 times, I'm going to sell them, and they stay 30, 40, 50 times for many, many years. So that's actually the challenge, is actually holding on to them.
Yeah. So with this global future leaders active ETF, you're looking for small and mid caps globally.
Yes.
Now the definition of small and mid caps changes if you're looking globally and if you're looking in Australia. So can you just give us a sense of the differing definitions?
Yeah, definitely. So Aussie, the mids and smalls are about 5 to 1 billion is sort of small caps, up to 15 billion is the top of mid cap. So that's about the Aussie range in Aussie dollars. Global range is around 2 billion US to actually 70 billion US. So that's a big range. So it's over 100 billion Australian dollars is where the end of mid caps goes to. Also, the age is very different. Like typically Aussie mids and smalls tend to be from what I call toddlers to teenagers. But the actual average age of a global mid cap stock is 28 years old. So if you just think from a human age perspective, you've finished uni, you've started your career, you're actually on a path already, and you've survived competition, challenges, a few cycles as well. So the actual maturity of those global mid caps is actually, quite advanced. So that's why they're good. And you have 20 years of history, which is huge. So, yeah.
Yeah,
Wow.
you just think about that upper limit of global mid caps being about 100 billion Aussie dollars.
Yeah.
And then you think about the number of large cap Australian companies that still fit that definition.
Yes, there are Aussie mid caps in our index too. So
a lot of investors have been focused on current leaders, shall we say. Magnificent Seven dominates the headlines.
Yeah.
Make the case for future leaders.
Look, the great thing about Aussie global mid caps, similar to Aussies, is that they're still under research. They're still a bit undiscovered. They've still got a pretty long pathway of growth, and that's really where they are still exciting. So still under research, still a good pathway of growth, and because they are under research, there's still decent valuations. So mega caps tend to be, heavily covered, heavily watched, chased in terms of indexes as well, passive investing. Whereas mid caps in the global space, they're just not. So the valuations are still very attractive, and it blows my mind to build a portfolio which has like a 20% return on equity, but you can buy that at maybe 20 to 22 times PE, which is just phenomenal. Australia is almost the opposite. It's double. So you can buy, the index is 10% ROE, growing at 10%, but it's paying 20 times for it. Whereas global, the index is 20% ROE. You're paying just over 20 times for it. And that's a really different dynamic. Global is a lot less momentum-y than Australia because the breadth and depth is very wide, whereas Australia is narrow and shallow. So that's why the valuation discipline can be allowed to be that attractive compared to large caps and compared to Australia.
So James, we want to now move to the discussion around the small cap rotation. At the start of the year, there were many predictions coming out from a lot of the big banks, and we've been hearing it from a lot of experts on the show that 2025 is the year of the small cap.
Yes.
The rotation has started. Is that what we're seeing?
It's not really playing out that way. There's been a massive shift in the market in terms of risk attitudes. So small caps works when risk tolerance is generally higher. It hasn't really worked. Like gold has worked, defensives have worked, low beta has worked, especially for the first few months of the year. So small caps definitely worked towards 2024. It worked quite well. It definitely there was a huge recovery. The Russell 2000 in small caps and mid caps as well. But now it is very different. So the shift in the market away in terms of risk attitudes has changed. Spreads have come in. Also, momentum and quality is now a much more under the microscope compared to what it was last year. There was definitely some quality momentum cheerleading towards the end of last year, especially, and it was held on literally for 2 years. So basically, quality momentum cheerleading happened through 23 and 2024. So 25 has begun with a very different attitude of risk, and that meant small caps and mid caps have basically been caught in the downdraft as well as the rest of the market. And now I think valuations top of mind, certainty is top of mind, risk is top of mind, and that just means the small cap rotation has kind of not happened, I guess, at the beginning of this year.
So what has happened at the beginning of this year is so much macro noise, trade wars, and potential inflation uptick as a result of tariffs, and basically just the US is making a lot of noise at the moment.
Yes, for sure.
How have you seen all that macro noise and uncertainty affecting the small cap universe?
It's just risk. Risk has been repriced. So that's the big thing. And durations have come in now. So what happened in 23, 24 is basically the attitude towards risk was loose. The cost of risk was almost nothing. And people's duration just went really long. So what that means is quality and momentum can really expand in multiples, especially quality, but also momentum. And when that happens, that's when, the mindsets are really long. Now what's happened is the opposite. It's gone short duration. So there's recession fear, inflation, rates higher for longer, tolerances are very low, private equity, people are worrying about private equity blow-ups, debt markets are getting really nervous, gold's at record highs. That's a very different world to what we had 2 years ago. So when you think about portfolios, you've got to think of three big things. Valuation is number one. You've got to have very strong valuation discipline. Two is duration needs to be visible, so you can't think about 3 to 5 years from now. So you think about data centers. Even 2-3 months ago, there was a huge raising in Australia and in the US. There was, very excitement around data centers and AI, and all that's come really short in now, really come in terms of duration focus. That's what's really happened. So I think valuation's got to be number one. Duration's got to be a lot more visible. So you can't be, in the clouds thinking about 3, 5, 10 years out. And it needs to be quite certain. So there needs to be a high level of certainty with things now. So it's quite a different world. And that's what you got to think about in portfolios.
It's just crazy how quickly it changed.
Yeah.
It is
3 months ago.
Yeah.
3 months. Yeah.
How do you, as a portfolio manager, think about positioning yourself for that change, and what are you watching? Because as quickly as it changes, it could snap back as well. So how do you just keep on top of all that?
Yeah, for us in global, we actually not saw it, but we sensed. Look, analysts were downgrading stocks quite significantly in the second half of the year in 2024, especially in the US teams. And London, our London teams and the European teams were getting quite excited because valuations were getting very attractive. And you had a lot of M&A in Europe from American companies buying out European companies in mid caps and small caps. So you saw this opportunity, and you could see what was happening in the world, that US valuations are very high, European was very cheap, but also the US being very high, analysts were getting very nervous about valuation. So we were pulling back on what we call the market leaders, which were very, very obvious, which was technology, financials, industrials, and consumer were all absolutely booming through 23, 24, but the second half of 24 just to new record highs on all those factors: valuations, attitude towards risk, duration, extensions. And they were all the analysts were getting really nervous, and they started to downgrade a number of stocks that were getting at record highs in terms of multiples. So we actually trimmed from August basically to Christmas. We were trimming financials, industrials, tech, and a bit of consumer as well, and started to move towards more value stocks, more industrial kind of normal stocks, more boring businesses that are just normal, trading on good valuations in Europe. We bought stocks in Germany, we bought stocks in France. So it became a lot more. So from being big overweight in the US and overweight in tech and financials, we actually went underweight financials, or very small overweight in tech, and actually underweight the USA, which is the first time since inception, to be honest. So we kind of saw that. So our trading hasn't really changed much, to be honest, at the beginning of this year, but we could see what you're saying. We could see that this was getting just too hot.
Yeah.
And the headlines from one of the financial analysts was too good to be true. Because they could see all the financials, your KKR, your Carlyle, your Ares, private capital markets. They were getting very cheap capital, very low spreads, very high leverage, and very attractive valuations on the exit. And it's everything's basically working. And from that, it's gone to now the opposite of things aren't working. So cost of leverage has gone up. The ability to get leverage has gone down. Valuations on the way out is not as attractive as it used to be. IPO markets are tougher and liquidity has come down.
Yeah.
So it's actually on private capital markets, you can see things changing very rapidly. So what you just mentioned, but they could sense that things were just too good.
Yeah.
So that was why, luckily, we saw that, and we got the very strong feed from Europe and the US that was what was happening. So we actually anticipated what's happening now. So we haven't actually moved that much in the last little while.
So for the Equity Mates community listening, sort of thinking about that there might be an opportunity now with a bit of a pullback, is now a good time for small caps, or how should we be thinking about it?
For us, it is, because the valuations are still very attractive. You look at free cash flow yield, you look at growth, you look at actual ROEs. It's still very, very attractive in terms of valuations. And compared to mega caps, people are definitely diversifying away from mega caps and diversifying away from the US. So you can get that exposure through a global fund into Europe. So we have like 30-40% of our fund is in Europe. Only 50% is in the US. And we also have a little bit of Japan as well. But the growth and the valuation paradigm is still very attractive. And that's what I think is the attraction.
So I think that's a good segue to a couple of stock deep dives. We asked you to bring a couple of stocks that are in the portfolio or on your watch list, things that you think are particularly interesting, and maybe bring to life some of the themes that we're talking about now. So you've brought two companies, Moncler and Brown & Brown.
Yes.
Let's take them one by one. Let's start with Moncler. For people who are unfamiliar, for people who are unlike Bryce and don't have a jacket full of a closet full of their jackets, what is Moncler?
You should have two. Moncler is a luxury outerwear brand. They are famous for selling like $3,000 jackets, which are status symbols in, say, European ski fields. So you wear a $4,000 European jacket that says Moncler on it, you have status, much like a Porsche, a Ferrari, or an LVMH handbag, or a $1,000 bottle of wine. It will give you status. And we love these things because it's just, as a human being, you actually have a brand that defines who you are. It's very unusual for that to happen. It's kind of reverse psychology, where you buy the brand and it gives you status, and it kind of defines who you are as a human being. And this is one that it does. And it's been around since the 50s, came around because of exploration in the mountains, and they wanted to create really solid jackets that actually would really protect people doing exploring in the mountains. That were the origins of it, and then it became very, very fashionable, very high function, very strong on fashion. So an Italian brand, Moncler, really high status, but also the financials look great. It's very high return business. It's been very stable. It's not volatile or not economically impacted because it is luxury brand. The wealth of the demographics are such that it always has, pretty decent, strong sales. It's been a long-term hold for us as a great business.
So before we get into the business specifics, I think the luxury story is worth just touching on for a second, because luxury has had a tough period.
It has.
And a lot of them have been sold off. How much are you thinking about the broader luxury story when you're looking at Moncler specifically?
Yeah, it has been very difficult. I mean, like most of the stocks have fallen quite a lot, and it's been very difficult. Some of them it's because of their brand positioning or innovation. Some of them it's been because they're very linked to China. For example, Moncler has a little bit of that. It was affected a little bit, but less so than the others. But luxury has been affected quite significantly. Just Moncler has been less affected just because of its status in terms of its positioning in the market. It's been a great one to hold for the long term. We've had it for 3 or 4 years. But a lot of the sectors have had massive, even luxury beverages has had a really, really difficult time, not just luxury fashion, clothing. So we've felt comfortable. We have been nervous. We did trim it, I think, late last year, but we have bought it back in towards the end of last year. And it has been a long-term hold for us over time.
It's been around since the 50s, you were saying.
Yes,
so
that's right.
Pretty significant history.
Yes.
What makes it still a future leader? What's the thesis?
It's still those things. So high viability, high sustainability, high credibility. They're a very respected brand, but also a very respected business team, very high ESG metrics, has been given awards for sustainability in terms of cotton and all of that sort of thing. So high credibility, accounts are clean, management's clean, sustainability is high, and the returns are very decent. Teen returns on capital, solid growth, has managed the cycle well. Like we were just saying, then the cycle's been really tough for luxury, but they've done better than the average because of the way they've managed the business and because of what the brand is in the marketplace.
Is it 100-bagger?
I don't know about 100 bagger from here.
That's a lot of jackets.
Yeah, that's a lot of jackets. It has been phenomenal. Like just let's just go from 2020, it's gone from 30 to 60. So it's kind of doubled in the last 5 years. So yeah, maybe not big numbers, but
on its way.
It's what we call a beautiful compounder.
Yeah.
So it's something that's quite stable. We're not trying to shoot the lights out with it, but it is a beautiful compound, and that's what happens over decades. Funny one is Sideshow is a Games Workshop. These little Warhammer miniature figures that people paint.
Yeah.
We every quarter we update our top 10 and look what they've done over a decade, and that's been the biggest performer over a decade. It's up over 40 times.
Wow.
Yeah,
So
crazy.
it's like and again, it's just this beautiful business that's a really niche product.
Yeah.
People love it.
Yeah.
People spend their life painting these minifigures, customizing things. Again, high ROE, high sustainability, and really high credibility. And when you read the annual reports, the management humbleness is just mind-blowing. Like, we're using your capital to do this. We've done the research on this, and we believe it's the right thing to do. We thank you for your, and it's just like, wow, like, oh my goodness, wow. As a corporate governance kind of mindset. That's what we call beautiful compounders. They're just these businesses that just sit there, do their thing. They believe that what they're doing is right, and they just keep doing it year after year, decade after decade. And the outcomes can be 4, 5 to 20x, and it's quite phenomenal.
So you said Moncler was up 100% in the past 5 years. I had a look at the past 10 years, it's up 200%. So it's nothing if not consistent.
Yeah.
How do you, after that run of growth, how do you think about its valuation today?
It's still very reasonable. It's on 20 times. ROEs are high teens. So for us, the paradigm makes sense. It's got growth. Its valuation is reasonable. It's and the VSC scores are very, very stable. So for us, it's still it's in our top 10, top 20 right now. So it's been very good and very solid. So we're very comfortable with it in terms of valuation and its outlook.
And then final question on Moncler, where do you see the risks? What would break your thesis around this stock?
Well, anything that really challenges that VSC. So credibility getting hit really hard, that would be a huge thing. Sustainability, question marks. So any sort of perception around fashion or function, which is considered to be weak as opposed to being very strong, which it's always been. And the return profile changing, whether it's competition from Canadian Goose or other competitors in the marketplace that basically erode its leadership. That would be where you start to think, okay, maybe it's not as strong as a brand in people's heads as you believe it is. And that's when you would start to reduce the position.
What about competition from Kathmandu? Do you worry about that?
It is luxury, as I said. So Columbia and Kathmandu are more the value propositions. North Face, Canadian Goose are definitely higher next, and then you got Moncler kind of up there.
One of Bryce and my business ideas back in the day when we were in Canberra and everyone wore Kathmandu jackets was to try and do a budget version of a Kathmandu jacket out of China and sell it in Canberra.
Called Kathmandu?
Yeah.
Anyway, glad we chose media. So we're going to go from the, I guess, sexy luxury mountain wear to an even sexier industry in insurance.
Yes.
Brown and Brown, the ticker BROUS. Bro. For those new to the company, what is Brown and Brown?
Brown & Brown is it's established about over 50 years ago. It's an insurance broker, basically. So it helps companies with programs, employee programs, corporate programs, and basically arranges insurance for them. So it's not a huge underwriter, which means it doesn't have big underwriting risk. It doesn't have the risks of insurance, which is insurance margins, return on tech reserves, and return on shareholders' funds. It's more of a broker. So the returns are very stable, and that's what makes it great as an investment.
I guess in terms of defining it as a global future leader, how do you see the next I guess, 5 or 10 years playing out? What's the growth thesis?
Yeah, this is a phenomenal business. It's actually now in our top 10, close to the top. Its returns on capital are 40%.
Wow.
So remember that the world average is around 9.
Wow.
And the correlation to total return and CFROI, cash flow return on investment, is incredibly high. So it's 9% of the world, and global equity returns for the last 10, 20, 30 years is around 9. Okay, so this has a CFROI in the 30s, and it has been in the 30s for over 20 years. So this is what makes it beautiful, and that's the outlook that we would expect. It's very well respected. It's in 18 countries. It's very well established. It's very strong, like process driven, and that return profile is just something that's very, very hard to find. Like I mentioned, those earlier ones in the Australian market. But this business has been great and expected to continue to be great. That return profile will hold, growth will hold, valuation still amazingly, it's in the 20s. It's around 28 times now, which is very reasonable for a stock that has a ROE profile of that and a growth profile of what it does. So it looks good. Is our view. So
I'm just having a look at its all-time chart. Since Google goes back to 1985, so 40 years, it's up 69,000%.
Oh my God.
It's well on its way to being a 100-bagger.
Yeah, wow.
But for me, I just think insurance brokerage must be like an incredibly competitive industry.
Yep.
And I'm sure every country, you said it's in 18 countries, I'm sure as it, tries to grow and become that 100-bagger, every country it goes into, there would be existing incumbents in insurance brokerage and people trying to start brokerages all the time. Like how does it, like what's its sustainable competitive advantage here?
Look, a lot of these businesses that have this kind of profile, it's just processes that are followed to the letter when they go into a new country or when they're at home base in the US. They've got processes about how you deal with a client, how you manage risk, how you advise, how you manage legal risks, etc. And all of that is just something that takes decades or, in this case, 50 years to learn and perfect, I guess. So much like many of these businesses that you feel like they're octopuses sometimes, and it's like if something's going to happen at the edge, they just have these amazing processes which keep them as leaders, I guess.
Just flawless execution.
Yeah, flawless execution because it's been tried and tested 20 years plus. And that's what just makes it what it is. And to be a 30% ROIC business, that is phenomenal in itself. Like that's like top 2% of the world. It's just phenomenal.
It's a real lesson that exciting investment returns can come in really boring businesses.
They absolutely can. Absolutely can. A lot of it is just it's like military precision. It's just this and it is boring, but it is just consistent. And a lot of these businesses that we find, they just do, and typically it's just they do one thing. They just do one thing and they do it really, really well. And so if you meet, many billionaires in the world, you ask them, what was the best thing you did? And it's, I just did one thing in my entire life. 40, 50 years as a professional, I did one thing. I just did it really well.
Yeah, I just did insurance broking.
Yeah, and that's a thing. But even the billionaires in our country, right? It's mining or it's property or it's fast food. It's it's just one thing. Yeah. But you just do it really well. And that's, I think, is the secret. A lot of these businesses that are global future, they just do the one thing. But they just have to, it's breadth and depth. They just do it well, but they do it, consistently everywhere.
So when you think about risks for a company like Brown & Brown, where does your mind go?
The biggest risk is culture, because that's where the process comes from. And they say, what is it? Culture eats something for breakfast. So
culture eats strategy.
Culture eats strategy for breakfast. So you can have the most beautiful strategy in the world, but if the culture is wrong, it'll eventually eat it. So so for us, it's culture, and you got to watch that. So you got to look at all the reputation sort of surveys that get done, listen to management. You can use obviously AI to analyze the sentences and market structures that are put in place when management talks. Make sure they're not getting too cocky, make sure they're sticking to the knitting, making sure they're not making any silly acquisitions. All of that sort of thing is what you typically want to see is very consistent. And what usually blows up companies like this is M&A, CapEx, competition, and arrogance. They're the big four that are usually ugly for what I call the quality cracks. And that's what you got to look out for with this kind of company and anything that's a high quality, high return business.
I imagine one thing that has been a spanner in the works of these companies over time, like they've found the formula, they've got an incredibly high ROE, and then they try and expand. And as they try and expand, and they just find that the ROE slips and slips and slips as things get harder and harder as they get bigger and bigger. Have you noticed anything like that with Brown & Brown, or it's just like...
Not with Brown & Brown yet. It's been very consistent for the last... Well, we watched it for 5 years, but the 20 years has been very consistent between 30 and 40% ROIC, and we haven't seen anything like that. But what you say is absolutely true, especially for Australian companies. It's very true. They usually conquer Australia and then go to the US or Europe, and then it doesn't work. Come back with a tail between their legs, losing billions of dollars.
Yeah.
So, you need to be very careful of it. And what we call that is the return fade. We'll analyze that return fade all the time, especially with quality businesses.
Yeah.
And because what happens is as you go up the return cycle and you're going from ROEs of say 10 to 15 to 25 to 30, your PE will expand from usually 15 to 20 to sometimes 40 times. But then the returns will actually start to fade, but the market won't see it until earnings miss. But you can see the return fade before you see the earnings miss. But when that earnings miss happens, your stock will go from 40 times to maybe 20 times or 15 times again. It'll go the opposite way. So you need to look at the return fade before you see the earnings fade. So it is very, very important to watch it, and it'll go down by 2, down by 2, down by 2%, but over like a 2-year period, you'll see it go from 20s to heading towards the teens or below. So it's becoming an average company.
Yeah.
But as the market's going quality momentum cheerleading and giving it upgrades in multiples, it all feels really good, but you got to watch that return profile very closely because it'll give you a very strong lead indicator.
That's fascinating as a lead indicator, that return fade. Does it work on the other side as well? Do you see a return inflection before you see an earnings inflection?
Yep, absolutely. So in mids and smalls, I've noticed there's basically 3 phases. So one is from big losses to less losses, losses to profit, and then profits to supernormal profits or profits that are sort of in that 15% level. And typically you'll get a stock that actually 3 bags in every single zone. So from big losses to small losses, it'll 3 bag. Then from small losses to small profits, it'll 3 bag again. And then from small profits to a ROIC of maybe 15 or 20, it'll 3 bag again.
Yeah,
Life 360 is a local example that you can see right here. Then it's gone up 9x from the bottom or close to the bottom. But it'll go 3 bag, 3 bag, 3 bag. And you can see that happen before the earnings happen because the returns are actually shrink. The 2-year outlook you can generally see in any financial software. 2 years out will get forecasts, and you can see that happening. And then you see the share price react when the earnings come out, but you can already see the return profile improving. You need to buy the 2-year forward or 3-year forward earnings movement, and that's how you can make, on the inflection points. That happens in that scenario when it's loss-making to profit-making. It also happens with cyclicals. So the global example we had is Cheniere. Cheniere example is Cheniere is LNG US. It's an LNG producer in the US, and in COVID, it was basically bottom of cycle when the gas price was very low, and they had 6 trains. They were going to 9 trains, but the gas price boomed because of the Ukraine war, and then in the US was exporting gas from there, from US into Germany, for example, and LNG share price, the LNG price went up. Now, that instance, Cheniere went up 400% from bottom of cycle to top of cycle.
Yeah.
And that's just that phase from making low returns to basically better returns or mid-cycle returns to or low cycle to top of cycle returns. And it went up 4x. So you can make the money in what we call innovators, so future leaders that aren't making money yet, kind of concept stocks, or you can make it in cyclicals and you can make 3x your money. Yeah, basically in both examples. But same thing, you just need to look at the ROIC. If you look at the ROIC 1 to 2 years forward, you can make that money. You just need to believe that they are right and that the market will eventually reward the ROIC, but they'll reward it when they see the earnings, not when they see the ROIC, because no one's looking at return on capital. They're looking at earnings, and then they'll pay the multiple on the earnings because the company will come out and provide confidence about next year's earnings. So the market, until it gets the information of year 1, bang, and year 2, okay, now I'm going to pay 40 times for it. And that's where the opportunity lies, because the market wants the information actually in their face before they actually pay up.
Yeah. Well,
Love that.
You say no one's looking at return on invested capital or return on equity, but after this conversation, I'm sure more people will be looking at it. We certainly will.
Yeah.
Screens galore.
It's a very strong lead indicator that not a lot of people look at because...
I think for us, this is a reminder why you've come on so many times before, and we'll certainly have you on again because I haven't heard of the return fade before, but that is really interesting. So, James, thank you for joining us today. Thank you for continuing to share your wisdom with us and the Equity Mates community.
Great. Thank you very much.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.